We have all been fed the dream of good returns if we just invest into a broader index over a long time period, buy consistently and hold. It's a flawless strategy, right? But then you've heard rumours of a possible index bubble. Is this even a thing? And if so, are we in one right now? Well, in this video, I'm going to try and answer these questions and a few more. Before we jump into the video, I just want to give a really quick shout out to my new patron Aidan, who's joined me in just the last week. I really appreciate your support, Aidan, so thank you. So, how do we start to unpick this index bubble question? Well, I feel the best place to start is by looking at what bubbles are and then try and draw comparisons of where we are at in the market right now. We actually have several historical examples of market bubbles, including Tulip Mania, the 1630s, the South Sea Bubble of the 1720s, the Japanese economy bubble of the late 1980s, the dot-com bubble of the 2000s, and then the most recent one being the US housing bubble of 2008. Well, the obvious factor in bubbles is that the financial asset or commodity needs to rise way above its historical average, meaning that the masses are continuing to buy even though the given asset or commodity is well above the historical normal with little regard to valuation. The second common characteristic is that the economy is at a point where it's highly stimulated. This can be through governments printing money, historically low interest rates, or excessive lending, meaning that money is being lent to people who really can't afford it. This can be clearly seen in the Japanese economy bubble or the US housing bubble. So this means we're looking at two things. One, valuations being significantly higher than the long-term average. And two, the economy being highly stimulated. Let's start with valuations. Are the current valuations significantly over the long-term average? Well, there's actually lots of indicators to look at here, and I feel the most standardised one and the easiest to understand is the PE ratio. So it's looking at how much you have to pay compared to the earnings you're getting in return. So a PE ratio of 10 would mean you're paying £10 for an annual profit of just £1. So if we look at the long-term PE ratio of the S&P 500, so that's the average PE ratio since about the 1950s, we can see that we're currently 89% above the long-term average, which is significantly higher. It was only higher during the dot-com bubble at a whopping 132% over. But as much as the US dominates the global markets, it doesn't make up the entire global economy. And if you're buying a broad global index, then we need to have a look at what the other half of the world economy looks like. So in addition, I've pulled up some data for the remaining world. As you can see on the chart, the red line shows the US, which matches with our previous data, being around 90% over its long-term average. But it's worth noting that the US is an outlier. The remaining world, so Japan, the UK and other emerging markets, are actually flat versus 2006. So as a global average, you would argue that we're around about 65% above the long-term average right now. It's important to note that we have been above the long-term average for 19 out of the last 20 years. This will be an important factor to refer to later on. I think this is a clear point for excessively high valuations wherever you look. One point to being in an index bubble. But that's not everything. Another contributing factor to economic bubbles is that the relevant economies are being highly stimulated in the form of either printing money, low interest rates or excessive lending. Well, it shouldn't come as much of a shock to many of you that it isn't looking too good on this front either. Where do we start? The US has printed nearly a fifth of all dollars ever just in the last year. The US has recently signed a $1.9 trillion COVID relief package, and to top it all off, their interest rates are zero. The UK is also borrowing at record levels never seen before. And interest rates in the UK are at zero, and you'll see similar themes across the world like France, Japan and other economies of note. So, significant stimulus to the economy? Check. It's not looking good. You might be sat there right now thinking the following.
What you're telling me is that the music is about to stop and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism.
Sorry, I enjoyed editing that far too much. Anyway, possibly yes, but I think there are a few factors you need to take into consideration first. I think there are three different areas to explore. The first is timescales. If I was given £1 million right now and told this was all the money I would ever have to invest, would I put it all into the markets right now? Hell no. But would I put some of it into the markets? Almost definitely. All the data shows investing in money is high risk right now, but I would invest some money as you can never be certain on the future. A bit more on this point shortly. The entirety of the dot-com bubble lasted a whole 7 years, from the very start of the rise to the bottom of the bust. 7 years is a decent stint of time, but it isn't when your time horizons are 20, 30 or even 40 years long when it comes to investing. You have more than enough time to purchase a bubble and get away with it. Let's look at the dot-com bubble. If you'd bought at the very, very peak of the dot-com bubble, and let's be clear, that would be extremely hard to do, then you would still be up 188% today. But if you'd bought at the bottom of the burst, then you'd be up over 400%. So on average, even when investing around the dot-com bubble, you'll still have made 300% return. So why are we so fearful if we are in the midst of a bubble? There is no denying that we're looking at highly inflated valuations in the market, but we need to remember that these are historical valuations and are based on historical data. If valuations keep on becoming more and more stretched, who's to say that today's valuations wouldn't be deemed as fair value in the future? A lot of you might scoff and laugh about what I've just said as some kind of whack job speak, but there's 3 things I think you should really consider. Firstly, we could be entering a new world of sustained low interest rates. When you look at Japan, their interest rates have been no higher than 1% since 1994. Maybe they happen to be the first country to encounter the natural evolution of any developed capitalistic market. Monetary policy which prioritises wealth of the rich, so those that hold stocks and shares, and prioritise the broader economy, means countries might be far less motivated to increase interest rates. And what do low interest rates do? They cause money to flood into stocks and shares. So if interest rates are kept low, maybe today's valuations could be the new normal. Remember the facts I told you before about the S&P 500 being above its long-term average in terms of PE ratio for 19 out of the last 20 years? Well, is it any surprise that its interest rates have been the opposite in terms of being below its long-term trend? I don't think it's any coincidence. Secondly, investing has never been so popular. Why, you might ask? Well, the biggest reason is technology. It has never been easier to invest. Can you actually imagine investing without the internet? I wouldn't even know where to start. And lastly, there's been a boosted demand for stocks of companies by your very own government. They're now making it mandatory for employees to contribute a certain percentage towards their pensions, meaning that without even wanting to, people are investing more. The more that goes into pensions, the more that goes into the stock market. All this means a larger demand for stocks and shares. So what's going to happen to the valuations? They're going to go up and become more and more stretched. The next factor is the situation we're in currently. History does seem to repeat itself, but maybe this time is different. I cannot think of a situation where businesses have been limited in their ability to trade, while investors have been so flush with cash. It's easier than ever to buy shares of your favourite beverage company, but it's equally never been so hard to purchase your said beverage at a bar. Maybe valuations are so high as people are stuck with the only option of buying shares, and earnings are artificially low as people can't really purchase the goods they would normally want to. My take on this is that you should only be fearful of an index bubble if you're for some reason trading broad indexes, which is unlikely in my eyes, as traders normally focus on single companies or single stocks. But if you're in it for the long term, then you should be more than prepared to weather any storm that might be coming our way. Personally, I do foresee more volatility than usual ahead. There are far more new investors in the stock market than ever before, the majority of which have never seen a significant downturn. This means there's a lot of weak hands in the market ready to sell at the first sight of a downturn, or they might be happily chasing the recent bull run when valuations are so high. The only true risk I can see on the horizon for index investing is a topic I covered on my channel last month. I'll put a link to the video in the top right, it's well worth giving a watch. But in summary here, I can actually foresee a time when there's more sellers in the market than buyers. And that's mainly through a large people in the population retiring and actually there being less demand as we've actually got shrinking populations across the world. But I would love to know your thoughts, so that's all for this video. See you in the next one.